Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar, the first one for December. First of all, I would like to apologize to all of the attendees today due to some technical issues. We had to start with a few minutes delay. However, back on track. Today's session, we will remind ourselves about the few important figures in the psychology of trading, as well as most of the traders know that to master the psychology of trading is one of the most important and most difficult yet underappreciated elements of learning how to trade on the market, regardless if it's the stock market, futures market, forex market, so on and so forth. And of course, it really doesn't matter whether you are full-time trader or just coming to the market right now. It all matters because setting your straightforward way of thinking will protect your own environment and, most important, your absolutely precious account balance. While of course there are a lot of sideway materials that one might actually acquire that are actually discussing separate market trading strategies. Very little, however, has been actually published specifically about the psychology of trading, particularly for active short-term traders. Now, why am I focusing on active short-term traders? It is extremely important, ladies and gentlemen, to understand that when we're looking at some, from an investor's point of view, we do understand that our account should be quite a bit larger than a normal speculative type of trading account for day-to-day trading. As well as speaking of day trading, all of the positions that we open are kept throughout the trading sessions, throughout the trading day, and of course they're closed so we can have a good night's sleep. Obviously, when we speak about psychology of trading, all of the emotions that are going through our mind on a daily basis can affect our rational thinking, and most of all, our decisions that we make on the market. There are a few actually very important groups that we have to discuss, which of course we have to compare the individual that is on the market versus the group that we're actually trading against, or much more importantly, we have to go with the herd. As a trader, of course, or investor, one is constantly fighting a battle between the need to think independently and, of course, avoiding the urge to fight market momentum or the herd mentality. Now, frequently, an actual currency pair, for example, idea that you have actually picked up could be a good idea, that you actually chose the right one to trade. So that thing is strongly in the merits of the trade that we fight the powerful momentum of the market itself or the group. Typically, we have chosen the right market direction. Typically, we have chosen the right currency pair or commodity, for example. But, however, we have not picked up the right timing. We will get to that when we start speaking a little bit more about our strategies, our individual entries, how to better actually understand when the market is, let's say, a ripe fruit, so we can start eating the profits. For a psychological state of emotion, I have also picked the four main states of emotions, which we will very briefly take a look at before we move forward to a slight summary of what we've learned so far. The four typical states of emotions, those are greed, fear, hope, and regret. Now, everything inside those are just under tree as to those four main states. The four typical psychological states of emotions, ladies and gentlemen, since the market has been made up for individual human beings who tend to act, of course, in a similar manner, a group of traders is formed. It is only the group's opinion that matters during a trend, its development throughout the trading sessions. But it's of course the individual's trader job to identify the clues as to when the market is about to shift direction. Of course, the clues are there, but they're always delicate. An unawareness and, of course, detailed understanding of these four emotional states is what keeps the sharp technical trader out of trouble by, of course, providing, ladies and gentlemen, a means to identify individual weaknesses. What does that mean? We will, of course, have a look at those four emotions individually and, of course, provide examples of how, of course, they influence a trader's ability to consistently make profits. Because this is what our focus is when we're trading on the market. The first one, we will take a look at greed. It is commonly defined as an excessive desire for money and wealth. Now, speaking of, let's say, market terms, greed can be always identified as a state of emotion that affects different needs of the human being. However, the desire to make money and wealth is what we are interested in. In trading terminology, it can, of course, specifically be defined as the desire for a trade, a particular one trade, to provide an imminent and unrealistic amount of profit. When the greed sets into a trader's mind, the focus on how much money they have made and how much more they could have made by staying in the trade sets in. And I do believe that most of you right now that are here have made their progress, or they're stuck in a situation like this one. However, there is a major fallacy with the type of reasoning. A profit, however, is not realized until the position is closed. Until then, the trader only has a potential profit, also known as a running profit. Greed also frequently leads to ignoring sound risk management practices. What does that mean? It means that we're so greedy to take on the advantage of the market that we ignore the signals that we're getting on our charts that the market has already been overvalued or undervalued depending on our direction, that it actually starts to reverse, wipe our potential profit, and even bring our account into a loss from this single position. This is what greed is. However, in the other aspect, taking at the opposite side of the equation, let's say, fear is defined as a distressing emotion that is caused by a feeling of impending danger, let's say. That's our second state of emotion, which results in a survival response. This holds, of course, true regardless of whether the threat is real or imagined. Fear, however, ladies and gentlemen, is probably the most powerful of all human emotions. Let me tell you that it doesn't really matter of I'm sorry, I'm just I couldn't help but just take a look at the comments that you guys leave me. They're quite interesting, and of course I do understand the anxiety into all of us, as well as me personally. I've made mistakes that involves you know, undermining some of the states of emotions that we're talking about right now. But focusing on fear, it's one state that leads to panic. And of course, panic leads to poor decision making. Obviously, fear is fear is only a survival response. People have been known to jump off buildings during market panics, of course. By contrast, it's an example, a brief example, that from you know, records back from 1983 until 2007. That's a 24-year of rally from 1,000 to 14,200 of the Dow Jones Industrial Average. But it only took 2 years to lose half of its value throughout the world recession of 2007-2009. That is a dramatic example of the power of fear, because people tend to flee when something is to happen, and most of all, something bad is about to happen, or it's actually happening right now. But don't get me wrong, fear is a very good emotion. However, it is one that gets you out of bad trades. If, for example, a currency pair pick hits its predetermined stop price and the disciplined trader exits the trade, then the fear of losing an excessive amount of money protects the trader from financial ruin. However, fear can work against the particular speculator on the market when he does not enter a quality setup because they have had a series of losing trades. What does that mean? It means that you've made losses of 2, 3, 5 consecutive trades, and you're so afraid to make another mistake that you ignore the signals of the market that tells you that this is a profitable trade, that it's good to enter here and take your profit there, for example. This is an emotion that should be controlled. I'm not saying that all emotions are very bad and you should, you know, permanently divorce yourself from all of those. Well, if we do so, how does that make us so different from a machine, a robot, or an expert advisor that is totally divorced out of any kind of common sense or emotion of whatever state? That means that to hold your emotions, to use what is good for your trading, is the most difficult part of realizing. A few more words about fear is when the market, for example, is in a state of panic or fear, the trader should never try to rationalize or come up with some kind of excuses why they should not get out of their positions. You see, during times of panic, it is always best to go to these currencies or instruments in general that are less risky. Okay. Risk appetite, let me speak about that a little bit, is a very good thing because risk appetite brings volatility. For a day-to-day trader, it is very important to have volatility. Otherwise, profits are not going to be realized. However, it is also important to understand that when the market is in distress, traders are always in the position to make irrational decisions, to push the market in one direction and another, making the market extremely choppy and difficult to predict. In those cases, we should pick the right instrument that has less risk in it. Let's say what we see right now in the European area, for example, the United States, it's all somehow, let's say, predictable. Okay, we're expecting the European Central Bank to unveil new portion of quantitative easing, probably at the end of the week. Also, we're expecting not the next week, but the week after, the U.S. Federal Reserve to probably increase interest rates. That will definitely slam the euro to the ground and probably even get it close to a parity against the dollar. But this is because everything is expected. You know, a cheap euro, expensive dollar. It is beautiful to trade, especially with gold or oil, for example, with the supply glut and the expectations of unchanged policy from the Organization of Petroleum Exporting Countries. The meeting is due on Friday, for example. You know, all of these things lead to might lead to mass panic, for example, to a massive sell-off of future contracts or spot trading products, for example. This is the market fear. So if you are not prepared for such a dramatic moves, or you are too sensitive and you cannot control your own emotions, it is better to wait that out until the water cools down, until we see more clear direction, more of a technical trading rather than fundamental factors that are influencing the market, to have a better prospect for beautiful profits. The next state of emotion that we will have a look at is hope. Hope is a feeling, ladies and gentlemen, of expectation and desire for a certain thing to happen. The easiest explanation of one state emotion. It is an individual's desire to want or wish or for a desired event to happen. However, hope may be the most dangerous of all human emotions when it comes to trading. Hope is when keeps a trader in a losing trade after it has hit the stop loss, the mental stop loss, of course, because a disciplined trader will always set a physical stop loss. Unless you are so disciplined and you are fully aware of your flaws, you know, where you can make a mistake in order to get your emotions subdued for a time being until they come in handy, so you can exit the market in your predetermined mental stop loss. When a currency pair, for example, is going up, traders will often remain in the trade in the hopes of recouping past losses. Every trader hopes that a losing trade will somehow become a winning trade, but let's get something clear here. The market is not a charity organization. This particular type of thinking is dangerous because the group, the market, could not care less about what you hope for or what is in your best interest. Rest assured, when your thinking slips into hope mode, the market will punish you for being in this particular state, and of course, take your money. Now, the final state of emotion, before we take a few steps into the trading biases, there are a few that we need to take a look at with just a few words. I'm not going to lose too much of your time. Regret, however, is defined as a feeling of sadness or disappointment over something that has happened or been done, especially when it involves a loss or a missed opportunity. The negative implications, ladies and gentlemen, of this particular emotion are obvious. It It is only natural for a trader to regret taking on a losing trade or missing a winning trade. But what is important here as a trader is not to hyper-focus on your losing trades or missed opportunities. If you lose money on a trade, then you should simply evaluate what went wrong and move forward. It is important to find where you've made that mistake. It is probably an indicator that it's not working well for you, so you have to switch to something else to reevaluate your own trading strategy. Or, for example, you have taken a more expensive price and the retracement hits your stop loss, for example. Then you have to determine, why has that happened? Should I have waited a few more minutes for the market to retrace a bit so I can catch a better price? Or maybe I should have been alarmed by the signals that, let's say, for example, a moving average is standing on my way to make that particular profit, which means market timing was wrong. But there are many, many different examples, ladies and gentlemen, that I can give you, but only those that you have actually already experienced will give you the best explanation of what you're doing wrong. However, it is the time to remind you that if you need particular help on overcoming your emotion, evaluating your own trading strategy, developing a new one, or you basically want to talk about the market, the only way to do that properly is to do it with an expert. That means we can always help, me or my colleagues. You can go to our website, GDMfx.com. Throughout the support department, you can request a call from me or any of my colleagues. And of course, whatever questions you might have, we will always be there to answer for you. Taking a brief look to us as humans, it is normal to experience all of these four powerful psychological elements when trading or investing on the market. However, being aware that these emotions are always right on your doorstep, it is the first step to being disciplined enough to overcome them. When you do, you will find the results of your trading operations dramatically improved. Now, a few biases here which are strictly into those that we've mentioned so far, but with a different aspect. We will have a look at the overconfidence bias. It is a state of emotion which is overinflated belief in your own skills as a Forex trader. If you ever find yourself thinking to yourself that you have got everything figured out, that you have nothing more to learn, and of course money is for you to take in the market, you probably suffer from an overconfidence bias. Now, if I have to be absolutely honest with you, even if I have more than 10 years of experience on the market and I've been always profitable, I can freely tell you that there is always something for me to learn, because the market conditions are changing every time. Every day we have something new that we have to learn, why this event or particular situation is affecting the market this way, to make sure that we have backtracked all that we know so far to see whether this particular event has not happened before we have been born or we have been in the market, to compare to today's market conditions. If it is something absolutely extraordinary and we have not seen so far, it is always important to remember that the market will punish us if we make a wrong decision. Therefore, making the right decision on the market will not be as easy as we think, because there is always something to learn. The dangers of the overconfidence is that traders tend to get themselves into trouble by trading too frequently, or by placing extremely large trades as they go for, let's say, for the home run. Inevitably, an overconfident trader will end up either trading in and out of bad trades, trying to lean into the profitable side of the market to increase its own account. However, in result, you will be risking too much on one trade that can go bad and wipe out most of your account. Let's take a look at the anchoring bias. Now, this is a propensity to believe that the future is going to look extremely similar to the status quo. Now, when you anchor yourself too closely to the present, you fail to see the dramatic changes that are possible as currency pairs fluctuate and the underlying fundamentals shift. It's something that we actually mentioned a couple of minutes ago on the overconfidence. It's connected to the anchoring bias. We're stuck in a trade or in a trend that we believe that it will continue, but it's actually reversing. The confirmation bias is also one extremely important side of the market, and a type of a propensity to look only for the information that confirms your own belief that you already have. Now, for instance, if you, ladies and gentlemen, believe that the euro-dollar pair is going to go up, you will look for the news, the technical indicators, and the fundamental factors to support that belief. Now, if you are seeking for a further confirmation, you will most probably end up in making smaller profits or end up into the retracing side of the market, as we mentioned at the beginning, which will hit your stop loss and will totally mix up your feelings about today's market or the particular pair. And one thing very important here for me to mention, it's the time to say that when you make your analysis in the morning, it is probably by far the best decision that you will be able to make on the market. So if you make your technical analysis or fundamental analysis early in the morning before you start, as your proper trading plan suggests, that means that whatever you do throughout the day, follow up with your initial decision, because it will be by far the most accurate that you will be able to make throughout the day. One of the final biases, we will talk about the loss aversion. Now, it is a state of emotion that is based on the theory that the pain, for example, that is caused by losing $1,000, just an example, is greater than the joy that comes from gaining $1,000. In other words, fear is more powerful motivator than greed. Now, I've seen that in many traders. You know, they're so focused on losing money, you know, to stop losing money, that they forget about the winning trades. You know, they forget about the good part of the market, which is when you make a trade, you always have to evaluate, how did I make that profit? What made me open a position here and close it there? Because this is how you will keep making the right decisions every time. And of course, reevaluating your bad trades will keep you from making bad trades again. Obviously, you have to be forward-minded. Do not look back. Always forward. Enjoy the profits. Do not regret the losses. The overcoming ways of the loss aversion, it's best to trade with physically set stop loss orders, for example. Many traders tell themselves that they will be ready with a mental stop loss level that they think about, and promise themselves, which is most importantly, that they will act on if the currency pair even reaches it. All too often, however, traders fail to act on their own mental stop loss. They let their emotions get in the way, and they start rationalizing their choice to stay in the trade until it turns around. So before being so good at setting and keeping mental stop losses, as soon as you enter a trade, you should set your physical stop loss to take your total emotions out of the picture. I hope I have been helpful today of reaffirming a few important aspects of our psychology of trading, as well as it is extremely important because of the following events. On Friday, we will talk about a risk management system that can suit most trading plans, and of course reevaluate trading strategies. It is the most important one. Next week we will have a look at the federal interest rate decision. We will talk inside from different aspects, what the traders think, what is actually happening, what might happen, and what we think that will happen, which is most important, as well as the investors' sentiment as well. And throughout the week, when we will have the interest rate decision from the Federal Reserve, we will have a look at some type of strategies that are suitable for the first quarter next year, as well as they've been compared to market expectations, as well as fundamentals, today's market, the shifting fundamentals, as well as some strategies that has been reevaluated, so we can give you a better picture of what you can expect. And today, that's all about it. I will see you again on Friday, and the most important next week, the Federal Reserve a rate hike revealed type of session. It is very good for most of you guys if you can manage to be here, because we will talk about a lot of important things that will take effect the week after that. So you will have a lot of time to position yourself ahead of the federal interest rate hike, the possibility of such. So don't forget to join in if you haven't done so. Register, and I will be here to present all that you need. Thank you very much for joining us. I'll see you next time. Whatever questions you might have, just drop them in an email, or go directly to our website, talk to the support department, or call us directly on the hotline. There will always be someone there to answer for you. Thank you very much. See you next time. Bye-bye.